I have a very good friend of mine who's a venture capitalist in Silicon Valley, and right after the first iPhone came out, uh, he called me and we had a long conversation. And he's an investor in my fund, and he told me that I needed to buy Apple in Pabrai funds. This was, I think, in 2007. Um, and and he told me and tried to explain to me the App Store and what that meant and kind of where this was going with the App Store and the ecosystem. And he also tried to explain to me. Actually, it was one of the most eloquent discussions I had with anyone about why to invest in Apple. And he highlighted the moat, but he also highlighted the fact that one of the things, put a pretty powerful computer in each of our palms, and he thought that that was a very significant game changer. And this was in 2007. It was well before Uber came out. It was well before a lot of other companies came out. And a lot of these companies could not exist if the iPhone did not exist. I mean, you just wouldn't have Uber if you didn't have an iPhone. It's just not possible to do it without a smartphone. And so it basically became the infrastructure on which everything got built. But uh, I'm one of these stupid people uh, that when people hit me with a 2x4 in my head with a great idea, I'm still not able to see it. And somehow we still limp along and do okay. And Arvind still wants me to talk to you guys. Um, so I looked at Apple at the time. It wasn't at a single digit PE. The moment something's not a single digit PE, I'm gone. You already lost me. The moment you get to something at 11 times earnings or something, uh, I'm lost. So clearly, um, I did not appreciate. I mean, I understood what he was saying, but I didn't want to pay up. I wanted a lot cheaper price to get a business like that. But even then, I've always been skeptical. And even today, if you look at Apple today, forget 2007. Let's look at 2016. So Apple trades at a pretty modest multiple. If you look at their earnings stream versus the market cap, it's very different from Amazon and Facebook. I mean, it actually produces massive earnings, and it's trading at less than, after you take out the cash, I don't know, I think less than 12 or 13 times earnings. I think Arvind may have the exact number. And that's not a high multiple for a business like that. But, I also play back in my head the graveyard of companies and technology like BlackBerry and Nokia and all these other ones that have had huge runs and disappeared. And Apple has something more than those companies have, because they have the App Store and they have habits. The important thing, this is what my friend in 2007 was saying, Mohnish, human habits are changing with the iPhone. And you have to understand when the habits change, that is very enduring. It was a great talk. I wish I had recorded that talk, because if I could play it for you, it'd be better than me babbling here. And so he was telling me about the habit economy, and all these habits were very important. And and I didn't appreciate that. And so today we have a situation where Apple's, I think, unit sales are dropping, but their earnings are still rising. And because the ecosystem just gets larger, there's over 1 billion devices which have apps on them. And every quarter, the number of devices that have apps on them increases, even if their quarter over quarter sales decline. And of course, they got a free tailwind from the woos of Samsung, if you will. But my take is that this is one of those things where you want absolute no-brainers, and anytime in the investing world you have doubts in your head, then you're better off just not going there. So, for example, for me, drilling into the shipping company half off is a lot more tangible to get comfort than I could get with Apple at 12 times earnings today. It's just, and that may be a mistake, but it's just the way I'm wired. And so someone else can hopefully figure that out and do better with it.
Yeah.
And of course, since that time, my venture friend sprinkles salt on wounds and reminds me what his Apple position is worth versus what his Pabrai fund's position is worth.
In the world of investing, stock valuation is a fundamental concept used to determine the fair value of a company's shares. Investors rely on various metrics such as price to earning ratio, price to book ratio, and discounted cash flow analysis to assess whether a stock is overvalued, undervalued, or fairly valued. However, there are instances where traditional valuation metrics take a backseat, and the prospects of a business become a primary driving force behind investment decisions. This phenomenon occurs when the growth potential and the future outlook of a company are so promising that they overshadow current valuation concerns. Mohnish spoke about his experience with Apple stock, but there are plenty of such instances when investors have missed the boat. Tesla is another example where traditional valuation metrics fail to capture the company's potential. For years, Tesla traded at a premium, despite skepticism about its ability to achieve profitability. Investors who recognized Tesla's potential to revolutionize the automotive industry with the electric vehicles and autonomous driving technology were rewarded as the company scaled production and achieved profitability. Another example being Amazon stock. In the late 1990s and early 2000s, Amazon was often criticized for its lack of profitability and high valuation multiples. However, its relentless focus on customer satisfaction, continuous innovation, and strategic investment in infrastructure and technology allowed it to dominate e-commerce space. Today, Amazon's valuation is supported by its vast market presence, diverse business lines, and consistent profitability. While stock valuation remains a crucial aspect of investing, there are times when the prospects of a business can justify high stock prices, such as disruptive innovation, scalability and network effects, market leadership and brand strength, future profitability, and market expansion are the factors that can lead investors to prioritize growth potential over current valuation metrics. Successful investors often balance the art and science of investing, recognizing the exceptional businesses with strong future prospects that can deliver substantial returns even if their current valuation appears stretched.